Good afternoon. This is Ken Long from Tortoise Capital Management with a review of the daily trading plan for May 7th, 2011. We have a bullish normal market. On an annual basis, using weekly RSI, we have a score of 64 out of 100, which is the high end of neutral. 10-day index reading is 28 on a scale of 0 to 100, so we are just slightly above oversold conditions. The percent stretch above the 200-day moving average is at 9.89%, coded white, which is bullish, but not as strong as it has been. The slope of the 50-day moving average is at 0.22%, which we rate as red and slightly bearish because it's been so much stronger in the last 6 months. ADX 14 is at 14.5, which is a weekly trending or sideways choppy market. And you can see here in the southwestern corner that ADX had come just above 15 for a moment and has now drifted down underneath 15. Plus DI and minus DI are about equal. With the selling pressure of the last 4 or 5 days, we have a almost purely sideways market. The ATR percentage is 1.01%. Which is right at the average of the last 180 days, right smack in the middle of normal volatility. On the gap stats for SPY in the last 30 days, the market has gapped down 12 times out of 30, 8 and 4. 8 times the gap down has continued with a failure, and the average has been minus 0.18%. 4 times out of 12, the market has gapped down in the reverse to close higher, and that's averaged 0.52% for a better frameable trade. 18 times the market has gapped up. 11 of those 18 times it has reversed to close lower for the rest of the day with an average of follow-through of minus 0.38%. And 7 times out of 18 it's gapped up and continued to go up for an average of 0.27. So on gap ups, the reversal has been more normal and has had a bigger move, so that's the way to frame that trade, to be ready for that failure of the gap up. The range stat for SPY is the average plus 1 standard deviation from low to high. That's been rated about 1.49%. You can see the time series on the 10-day index. We are just coming out of oversold conditions on SPY, so that allows some upside movement in this bullish market. And in fact, we have 2 signals firing and channeling, IWM and EFA, and then the overreaction system signaling long for EFA, which is the Euro-Asia mix. EPP is Asia less Japan, and ILF is Latin America. You can see the pivot points for SPY, the daily pivot at 134.35. You can see volatility here has come right back to the 6-month average, right smack in the middle of normal, and the ADX we've already seen. On the 10-day maximum pain in Dow 30, we have a couple energy companies, ExxonMobil and Chevron, and then the other commodity symbols in the Dow, Caterpillar, Alcoa, and DuPont. ETF 100, most liquid. The 10-day max pain silver, a couple oil ETFs, gold miners, and Deutsche Bank blended commodities. Only a handful of pattern trades going into Monday. Gold is on a 551W, channeling signals in a lot of the large indexes. EFA is the Euro-Asia mix, IEV, European 350, U.S. small cap, silver, oil, blended commodities, and energy. In the large cap, we have channeling signals in General Motors and General Electric and ExxonMobil. The Elder Safe Zone signaling weaker price action on Friday, again for the blended Deutsche Bank commodities, DBC, agriculture and energy from the commodity sector, European 350, and then USO, the oil sector. 3060 Stealth, these are symbols that have that were horrible 2 months ago that have slightly improved in a quiet manner in the last month. It's the financials, technology in Japan, and then among the Dow 30, it's Microsoft, Cisco, Procter & Gamble, and Walmart. Modified French momentum are symbols that have had a terrific year but a horrible last month, so potential buy on dip opportunities if they find support in reverse, and that would be your blended and agricultural commodities, DBA and DBC, silver, energy, and then among the Dow 30, Chevron. Dow 30 tactical summary, quite a large number of dojis from Friday. Two signals for channeling. Again, we saw GE and ExxonMobil. No other patterns firing. Max Payne range compression, Chevron, ExxonMobil, Bank of America, Home Depot, Coca-Cola. And among the ETF 30s, only one doji in gold on Friday. And a number of channeling signals that we've already seen. No other pattern trades except for gold in the 551W. Max Payne range compression, silver by a large margin. We'll see that in the chart in the under the charts of interest. Followed by oil, blended commodities, Latin America, ILF, and DBA agriculture. Looking at the market mosaic indicators, we have the blue line is the slope of the 30-day regression line, R squared at 0.41. Still shows a strong descriptor of the slightly upward trend. You can see that 2 weeks ago we had some buying pressure, and then some sell-off has given us pretty much a sideways market. The slope of the regression line, the time series, you can see below it has crossed back over its 10-day moving average and drifting down based on the selling pressure of last week, and that puts it right at the 180-day average, which is the thick black line. This is the time series of the 30-day regression line that goes back 180 days. You can see we were right in the middle of the last 180 days, right at the average. Now, what's a concern here for the long side is that you can see on the percent stretch above the 200-day moving average, we've not been able to get above one standard deviation. It's hovering right around this 10% mark right here. We're about half a standard deviation above it. It has not been easy to get follow through. We're going to have to get above this swing high here at 137 in order for this to turn up. If it turns up, we've got a 10 to 12% move available to the north, but we've had two tests at it already and it hasn't really worked. And you can see how each subsequent surge upward has had a lower regression line slope, and that is evidence of a weakening bullish trend that began last fall and has been running out of gas here after two strong legs up. So there's some concern about weakness to the downside, and the market is positioned for a strong move in either direction once it breaks out of this trading range. Just some references for the gap stat that we trade in the usual way. Interesting to note that the gap stat in silver has almost doubled as a consequence of the volatility of the last 2 weeks. It's up at 5.98%. Last week, about this time, it was down around 3.5%. So the volatility in silver has been pretty extraordinary. The holding X days chart, haven't talked that much about it, but I want to show you just how important it can be to see where we are in the various holding periods. And we'll just take a quick look at silver right here. So there are really 4 time periods to look at here: 40 days, 20 days, 10 days, and 5 days. And this summarizes the statistics of the last 5 years. In the last 5 years, there have been the biggest 5-day favorable move in silver was 26.73%. The largest adverse move was 28.65% loss. As of Friday, that loss was minus 26.45%. That's a 5 sigma adverse move, which is quite an extraordinary move. Not quite the worst we've ever seen in the last 5 years, but really a significant emotional event. For the 10-day period, it's lost 24.25%. It's a 3.5 sigma adverse move. On a 20-day basis, it's lost 11%. That's 1.33 standard deviations. And on a 40-day period, it may not feel like it, but it's actually been up 0.35%, almost flat given the last 40 days. That's how much steam has blown off that trade. Now you can use this chart to get an estimate of the quality or the magnitude of the move that you just saw. If you look at some of these other symbols in the same period, they're all of these large indexes have lost over the last 5 days, but only one of them, gold, is more than one standard deviation of a move. So that tells us the selling was really localized in silver. It's silver unique. However, the broad-based weakness across the indexes tells you this is something like a market condition pullback. You can take a look at the Z-score, which tells you how many standard deviations each of those respective moves have been compared to each symbol's history. And by looking at the smallest standard deviation is Japan at 0.01, is actually relatively the strongest of the indexes over the last 5 days and so on. And on a 10-day basis, Japan has actually had the strongest move of all of the indexes here on the chart. So this gives you a insight into how much of a normal move might still be left, or how to properly describe the move that you've just seen based on the time frame that you're interested in holding. Okay, moving on. Looking at the Dow Quality Report, I've got this sorted by the 2-month ago period, and I'm looking for horrible and then not so horrible, and that leads us from red to yellow or red to white. So I'm interested in Cisco, Microsoft, and Walmart. Now Procter & Gamble is of interest because its 30-day quality score in the green at 3.54 makes it one of the standouts in terms of quality in the Dow over the last 30 days. So we may have already seen the easiest money that can be made in Procter & Gamble. So I'm looking for things that are red and then getting to yellow, and I call that the stealth trade because I think there's more room for that to grow before it becomes a big news item. This chart is the same basic idea, but for the ETF 30, and this time I've got it sorted by the divergence column between 1 month ago and 1 year ago. So the last column here, 31 to minus 260, computes a system quality number for the -1 to -12 months, and so that's the last year excluding the past month. And in the modified French momentum, what we're looking for are things that are in green in this column and then red in the last month. Get the idea being that we've had an extraordinary month, an extraordinary year, and then one horrible month, and then that may allow us to buy a strong sector on a rebound after all the monthly selling has expired. So we'd be looking for things that are green and then red, and that leads us to DBA, DBC. Silver's getting close, energy and coal. So that's the application of some modern portfolio theory there. And that gives us some stealth trade potentials. Gap statistics, just for your reference, for a lot of the large indexes, and then the safe zone channel for SPY, and you can see that just how sideways this market has been. Pivot point calculations for reference of the broad indexes, plus a few that we're interested in from the large caps. Relative strength score, you can see that technology has actually been doing pretty well. Mid caps and small caps have been lagging SPY, and they're between 1.5 and 1 standard deviations below the strength of SPY as the market's gone sideways. These two leading indexes have actually started to drift. I'd like you to take a look at the 4 standard deviations below normal for DBC and 2.5 for oil. That's a measure of the magnitude of the sell-off of this past week. Quite an extraordinary. This is comparing the slope of the 30-day regression line of each of these indexes to SPY, with SPY being the zero line. Safe zone calculations got measurably weaker in in the European 350, and then the Deutsche Bank Ags, blended commodities, and energy. Top 15% winners and losers based on 2 look-back periods, the 10-day and the 30-day. With the idea being looking for momentum extremes on both ends of the curve. And then the last reference chart, the correlation coefficients between the indexes and SPY and the indexes in themselves. You can see again here how in the red this is exceptionally low correlation, and right now it's Japan against the rest of the world, and that's really because of the powerful selling that they experienced a month ago, and then the actual outperformance of this past week where Japan has been more resilient than the rest of the world. So that's a quick look at the daily trading plan for May 7th, 2011. A number of pattern trades, but really we have a sideways market with a narrowing trading range. If it can hold support from Friday's low and break out north of 137, that will be a vote for equities long. And I would expect then to see commodities continue to be weak. But if it fails here, there's also plenty of room on the downside for a 6 to 7% correction before we even get to a 10% pullback from 137. So this is a non-directional market, and we should be looking to take advantage of tactical trades intraday and on swing basis, but being ready to capture the profits when we see them and ready to stop and reverse as needed. So this is Ken Long from Tortoise Capital. Good hunting. Keep your powder dry and your risk measured.